Hey, what's good everybody? Dustin Tibbetts, financial advisor with Jazz Wealth Managers. Hope you're having a great Wednesday. So far, so good. The market's doing okay today, so far. We'll see how that finishes. Of course, at 4 o'clock, we always update you. We do a market overview. We come back here, do this live again, and so we'll cover you there with that as well. This week, I forgot to put the glasses on. This week, we're doing geeky talk, right? So normally we focus on, I can't do it. So normally we focus on really just general stuff to help you get going with your retirement, help you with investing, little tips and tricks and questions that we get. We try to help you out with those, but every now and then we get sort of into the woods, really deep into different topics that, questions that come up from people that are really sort of complicated issues. And so Monday we did it, Tuesday we did it, we focused on speed. Today we're going to focus on speed a little bit, but I want to bring you into the business a little bit here. So something that you will not find anywhere else on the internet, anywhere really, nobody's going to tell you how this works. I'm going to share this with you today, giving you exact specifics on how Wall Street actually works. How do your trades work? And why is it that some places like Jazz Wealth don't actually charge you a commission? So we're going to go over that, show you all the details. Now, my background comes from these companies where I handled all of that. I was a part of all the trades coming and going, and so I got to see how these people made their money. I also taught thousands of people all over the country, all the globe, in Singapore, Israel, Portugal, Brazil, and of course the US, how it all works, right? And so that was my job. And so I'm one of the only advisors, probably I'm very confident I'm the only advisor here that you're online that you're going to find that's actually going to share this with you and tell you how it works. Now, before we get into it, I am not trying to say that there's something wrong or this is a bad thing. This is just how it works. It is actually really, really good for you, and I'm going to spell it out why this makes more sense for you, give you specifics. By the way, first round of towels went out to our customers yesterday, so I don't know, there's a little delay, but if you're one of our customers and you want one of these towels, let me know. If you've already sent me an email, it is on the way as of yesterday. So that'll be in the mail coming out to you here shortly. What I did is just made a simple little towel. Look, it just says, the markets recover 100% of all declines 100% of the time. So that you know when the markets fall, you can wipe your sweat off, you know, you can be like, oh man, oh, I don't need to be worried. Oh, okay, cool. If you're invested correctly, then no problem. All right, let's dive into it. Here's the question. Why don't you ask why you're trading for free? I'll use Robinhood as an example. I won't say anything bad about them, but you trade for free there, don't you? They don't charge you anything. Yet nobody asks, how do you make money, guys? Right? How is it that you offer this free trading to me? Hey, Dustin, you have a dividend portfolio that has 100 stocks in it. How is it that I don't have to pay $3.95 of trade, $4.95, $5.95 for every one of the positions in there? You got 100 stocks? Who's paying for that, right? Nobody ever asks. In any other business on the planet, right? And honestly, not one person has ever called and said, Dustin, why is it free, right? Everybody always just says, great, I don't pay trading commissions. I'm in, let's do it. So nobody asks. But yet, if you get a phone call, hey Dustin, congratulations, you won a free trip to the Bahamas on a cruise, you hang up because you know it's not true, right? You go, no I didn't, I didn't win a free cruise. If you go to a restaurant and they start slapping steak down on the table and they're like, it's free, eat up man, have a good time. You're not eating that steak, I'm not eating that steak, right? You hear the commercial for the car dealerships, come on down this weekend, we're giving away free cars. No you're not giving away free cars. But yet when it comes to investing and we say it's free, everybody's like, cool, I don't want to pay anything. All of a sudden. Which leads me to the index funds, by the way. That's one of the bigger sort of things that most people don't realize. You are sold index funds. When you think to yourself, I'm going to just buy an index fund and I'm going to enjoy the ride. Oh boy, I'm going to get some negative comments on this one. Look, the index, the S&P 500, the Dow 30, the NASDAQ 100, it's just a measurement. And the measurement you can't buy, right? You can't buy the S&P 500 without using an index fund. And so a long time ago, people started not wanting to pay for investments. And so Wall Street said, we got to do something about this. And so they came up with index funds. They said, look, if you show this on TV all the time, the S&P 500 was up 20 points today, and we can get people focused on that, then we can sell them an index fund, which we do no work for, and we could charge them a little bit. As long as people feel like they're getting something that they're supposed to, then there'll be no problem. The reality is you can do better than what you see on TV. You're supposed to do better. Everybody does better. If index funds are so great, why doesn't Donald Trump own any? Why doesn't Tim Cook of Apple own any? Why doesn't Elon Musk own any? You can look up the holdings of any public CEO and see what they own. Why doesn't Warren Buffett own index funds if they're so great? Well, it's because they want to do better. They get richer by understanding speed, what we talked about the last few days, and understanding where to invest. The general public is sold index funds because Wall Street still needs to make some money, and if you're focused on not paying anything, then that's what they're going to offer you. If they were to, think about it. A good example is North Korea. For years, you're told North Korea, bunch of maniacs over there. They're all crazy, right? During election seasons, oh, North Korea, they're bad people, man. You don't want to mess with them. And now all of a sudden, you're being sold the idea they're good, right? Oh, this guy's not so bad. Little tubby Kim Jong, whatever his name is. He's a good guy, right? And eventually, we'll all believe that it's fine. So the same happens with these index funds. That's a completely separate video. I know some of you are going to highly disagree, but that's okay. So here's what we're talking about today. Have you ever seen the commercials on TV? I think Vanguard, don't hold me to this one, but I think Vanguard charges $5.95 a trade, right? You've seen the ones for Fidelity, and I think they're the same, really. I think they're $5.95 a trade. TD Ameritrade, they're $6.95 a trade. That's the commission you pay per trade. Buy 1 share of Apple, pay $5.95. Buy 1,000 shares of Apple, pay $5.95, right? That's how they make their money, or that's how they used to make their money. Now, inside of this, there's costs for them. Of course, they got customer service, amazing platforms, amazing technology, everything that's built in. There's an SEC fee, there's a FINRA trading and activity fee. These are all very, very small costs that these guys have to pay. So at the end of the day, they may end up with something a lot less than the $5.95 they collect off of you. And they actually calculate it by share. So we do the same here. We have 100 stocks in our dividend portfolio, and we know that we like that, right? We want to have 100 stocks. And so if we were to have to pay $5.95 for every single one of those, you guys would not use us at all. It wouldn't be a viable business model. So what we have to do is break down, and what Vanguard, Fidelity, and TD, what they do, and even Robinhood, we'll talk about them in a minute, they break down their cost per share, right? And so to kind of let you in on it here, what is Jazz Wealth's cost per share? So if every time a customer calls, and we have customers that call and say, Dustin, buy me some Apple. Dustin, I want to invest in Verizon. I see what you're doing for me. Love your portfolios. I'd like to own some at Ford or whatever. So at Jazz, our cost is approximately 2 cents per share. All right? No other advisor, well, most other advisors just buy mutual funds, but every time we place an order, it's about that much per share, okay? But yet we don't charge you anything. All of our customers, every day we ask customers to invest every single week, and we tell them, go ahead, put whatever you want in every week. We'll buy it all. We're not worried about the cost at all. We won't charge you for it, okay? So here's how this works. This is sort of the sneaky part of Wall Street here. We have a cost of about 2 cents a share. What we do is we take all of the orders, all of our customers. Let's say in our, I'm just going to start making up names here. Let's say we have Apple and Verizon and AT&T and Ford, Netflix, right? Let's say that a portfolio of ours consists of all of this. And inside of this, we've got so many customers that want to buy Apple, so many customers that want to buy AT&T, some people that want to sell Netflix, we've got some people that want to buy Ford, and so we've got all these orders. What we do is we take the entire package, we go to Folio, right? We get with all of their other customers, we take everybody's package together, all in one shot, and then we go to Wall Street and we say, hey, who wants to buy this from us? Not the shares. Who wants to buy this whole package? So we've got all these orders in a big basket. We go to Wall Street and say, someone want to pay us for this? Right? We'd like to get paid like 2 cents a share if possible, because that's our cost. And we go to companies and say, here you go. Someone please pay us money for this. They will happily pay the money for this. We're going to talk about that in a second. But they will happily pay us our cost to take all of our positions. The best part is you are the one that benefits, not us. We don't make any money off of it. Our goal is not to make money off of all these transactions. The very next day, when people start putting more contributions in, all of our customers and everything, we do the exact same thing every single day. We go, here, Wall Street, take it. What you don't know is this doesn't actually make it directly to the market, right? And again, I'm not trying to scare you, but we don't actually say, and nobody does this, by the way, when you have an account with, say, Robinhood or a brokerage firm, TD Ameritrade, when you place the trade never goes to the market. So when you see on TV, they're like all the people running around on the trading floor and stuff, they're not working with your orders. They could care less about you. You never even communicate with them. You're communicating with these big companies that buy all of it from you, and then they piece it out and they do whatever they want with it. We'll explain what they do in just a second. Now, other companies, other investment companies that have tried to do this, they say, hey, tell you what, if you want to invest for free, you have to use this fund for your financials. You have to use you have to use this ETF. You have to use this ETF. You must use this ETF. And they build the portfolio because they make money by going to those other companies, and instead of selling them for 002, they'll go to them and say, we have the best products. We want 004 per share, because they know that those companies want it. So you're at a disadvantage at the other companies because you're forced to choose investments. Over here at Jazz, we don't care. We don't need to make a profit off of your orders. So you're free to pick anything you want. We are free to build any portfolio we want with any stock because we can get someone to pay that for us. So there's no trading commissions at all. Now, this is all publicly reported, by the way. This is not a secret. Every company has to report to the SEC exactly who they sold the orders to, how much they were paid back for it, and how that sort of played out. So to give you an example, who are these companies that pay this money? So the first one of the coolest companies on the planet, Virtue Financial. It's a public company, but their business is to buy orders from people. And here's how they do it. This is really, really sort of cool. Let me put the other one on there. As far as we go, we deal with them 51% of the time. These guys are the highest bidders. And again, this is all public. The next company we deal with, Citadel. Right? And so the goal of today is not really to like bore you to death. It's just to give you an insight as to how this works. So these are the two companies we primarily deal with. The other ones are Cowen and Associates and Cantor Fitzgerald. We don't deal with them very much. And so they will pay us every day when we put your orders together an average of 2 thousandths of a cent per share. Okay? Why do they buy orders? What benefit does that do? Why would they get in the way? Well, here's what happens. These guys, remember we talked about speed all week. We've been talking about speed, okay? Speed is what gets you to your goal. Speed is everything when it comes to investing. Picking a stock, I don't care what stock you pick, as long as it's moving at the right pace, I'm happy. Think of a car. If you're in a car and you're trying to get somewhere, drive too fast, you're probably going to crash, it's going to hurt. Drive too slow, it's going to take you forever to get there, and you may even miss your deadline. You're trying to get there in an hour, you may not make it in time, okay? Drive the correct speed, and sure, you're going to hit a pothole, maybe a deer, right? Something comes out and you have to stop. The guy in front of you slows down a little quick, but as long as you get back up to the speed you're trying to move at, you will get to where you're trying to be. So these guys understand what they do is they take in as many orders as they can, and they pay everybody for these orders. And what they do is they say, all right, as the orders come in, we've got a seesaw. So let's just say their portfolio consists of, we'll use a seesaw as an example. So they're taking in all these buy orders just all day, hundreds and hundreds of millions of buy orders, okay? And then they're taking in a bunch of sell orders, right? And they balance them out. Some of them will offset, but what they do is as they take in these buy orders, let's say the portfolio cost is $186.49. So after everything they've brought in, it's that cost per share, all the hundreds of millions of shares, okay? Now what they do is they take the stuff that they can cancel out. They can say, okay, we have this, right? We've got this, we don't need that. We got this, and we got this one. We're left with some long positions, okay? And so what they'll do is they'll say, all right, at the end of the day, we're weighted to the long side, meaning if the market drops, we could be in trouble. And so remember we talked about speed? Stick with me here. I don't mean to confuse you. But at the end of the day, remember we talked about the market moving at some speed and a portfolio moving along at that other speed. So let's say at the end of the day, they're moving at 20% of whatever the market does. They can't have that. They can't have a portfolio that has risk to the downside. And so what they do is at the very end of every day, after they've bought and sold and bought and sold and bought and sold, they reduce the speed of their portfolio to 0. They're not interested in making money off these positions. They're interested in having no risk overnight. So when the market opens up the next day and it's up so many points or down so many points, the speed of their portfolio is 0. It didn't move at all. And then they can start the game over again. Dustin, what shares do you have for us? Well, okay, cool. We've got a bunch of buy orders. We've got a bunch of sell orders. They repeat the process. Now, here's how it works. Let's use the, I don't know, let's pick a stock. 186. What's trading around 186.50? Apple. So let's use Apple. Let's say Apple is 186.49 bid by 186.50 offer. You guys know what a bid and offer is? Hopefully I'm not confusing you. Let me know if I need to go back and do anything over again. I'll do it all again if I have to. So this is the bid and this is the offer. And if you've ever traded on a platform, you know what this is. All right? Now, everyone that wants to buy is willing to pay 186.49 for Apple currently at the moment. Everyone that wants to sell for 186.50. There's no match there, right? People want to sell for slightly more than everyone that wants to buy. So what these guys do is they say, I'll tell you what, when we take all of Dustin's orders, all of Jazz Wealth, all of Folio, everybody together, when we take them, we know that the best price that we can buy and get filled at right now is 186.50. But let's do this. Instead of doing that, 186.50, let's let Dustin's team have it for 186.49 and 0.03 of a penny. What just happened? If you're one of our customers, you said, Dustin, I want you to buy me some Apple, and the price is 186.50 to buy it now, I just got you a better deal, right? Because I worked with these companies and I didn't go directly to the market just yet. I went right here and I said, look, tell you what, I got you filled at 186.49 and 0.03 of a penny. What do you think? You're ecstatic, right? You thought you were going to pay more. You saved a little bit of money, not a lot, right? But you saved a little money, right? In exchange, this company gave us this deal and they had to pay 002. Okay? So they let us have that. So all in, you can see what their cost is. Now what? Now, remember the seesaw. So they've got this seesaw going on here. Is that what it's called? The thing, the balance beam? Let me know. So they just took on, right? We wanted to buy, and in this case, they sold to us. So they had shares that they sold, okay? And now they have some Apple. Now, what their cost is, they've got to go fix it. So what they do is they immediately try to pair it off with some other trade that they have. Remember, they're doing this hundreds and hundreds of millions of times a day. So they just go, all right, fine, we'll take it. They may already own some Apple for 186.48. I don't know, whatever their average cost is. And they track this by the millisecond. So they know that even though this is, what they had to end up doing for us to sell it to us, they know that their average cost is better, right? So they know what they can do as far as making a profit. Now they do the same on both sides. And the goal, again, is not to make a profit off the stock. The goal for these guys here is to make a net profit of 0.003 per share. That's all they care about, right? But they'll do this 100 million times in a day. Probably, honestly, a lot more. They do it 100 million times. So what do they end up with? By simply facilitating transactions, by giving our customers a better deal, by covering our cost, and then on the flip side, giving the other side of the trade a good deal, a better deal than they expected, the people that want to sell, and then covering their cost. At the end of all of that, this happens in the blink of an eye, by the way, they end up with what? $300,000 in a day. Now remember, if their seesaw gets out of whack, right, or teeter-totter, yeah, teeter-totter, that's right. So if they do this throughout the day and somehow there are more buys than sells, or in this case it would be sells than buys, if for some reason they're weighted to the long side, they will reduce the speed of the portfolio down to 0. They'll use options or any kind of derivatives. They'll use any product they have to make it even. And so the next day, if the market's open way higher, they don't care. They're not going to make any money off it. The market's open way lower, they have 0 risk. That's their job. And so if you look this company up, it's a awesome study. In 2016 and all of 2017, not one day did they lose money. So think about what happens here. The world is letting you, I am letting you trade for free. You got a better price than what you expected. And that's the big one there, is that you are at an advantage for being able to trade for free. So the customer gets a better deal. The brokerage firm gets their fees essentially paid, right? They don't have any costs now for making these transactions. The other side of the trade, remember, when you want to buy, somebody has to sell to you. The other side of the trade that wanted to sell, they're getting to sell for more than what they thought. Remember that example of the bid and the offer, right? So you've got the bid and the offer that were a penny away from each other. The spread in between was a penny. So if we give this customer a better deal, sorry, all right, I'm losing it. If we give this customer a slightly better deal, and then we give the other side a slightly better deal, and then we end up paying everybody, right, down the middle, we're going to end up with just about 3 thousandths of a share as a profit. So they figured this out. Now, this isn't something where people just like sit around and ask for these trades. It's all electronic. And the way you can tell that it actually happens, go look up, what's a good way to do this? If you have a level 2, if you've ever heard of level 2, if you have a brokerage platform, a standard one, like a TD Ameritrade or something, then type in a symbol and look for the level 2. Otherwise, go to the NASDAQ website and just type in like Apple level 2, all right, or Apple time and sales. That's what you want to look up. And what it'll do, there's a running receipt every day for every transaction on every stock in the market. And you'll see, right, you would think you would see a bunch, if you're looking at a receipt, if the stock is trading for 186.50, you'd think you'd see 186.50, right? Then maybe a 186.49. A couple other people decided to sell a little cheaper, right? And then maybe someone decided to jump up there and pay a little bit more. But that's not what you see. On the receipt, what you're going to see is a transaction for 182.50 and 2 thousandths of a cent, 186.49 and 8 thousandths of a cent, 8,000, 2,000, right? When you see that on the time and sales, that's us. That's all of us doing business for you, so you don't have to pay anything. So it is 100% a great, great deal, and this company never loses money. This company, well, they do other stuff, but for the trading side of things, they never lose money. Have you ever heard when Goldman Sachs reports their earnings and they say their trading division made profits every day for the quarter? It's not because they guessed the stock. They have no clue what stock to guess. The analysts there are going out of business because an analyst telling you that the stock is a buy is a random guess, and it's been proven by all these models. So when you buy Tesla and you think, oh, I'm going to buy some Apple, oh, Dustin, man, I'm going to buy some oil, I'm going to get some gold in there. Oh man, this is going to be great because I think the price of gold's going to shoot higher, the market's going to fall. Oh, Apple, they're going to do great. Tesla, they'll figure it out, you know. And oil, look at oil today, it's going crazy. You're guessing that all of this will continue, and you are likely going to be wrong if you will not hold long enough. What these guys do is they say, how much junk can we put in one pile and have 0 risk? We don't care about the stock going up or down. All we care about is what we have is not moving at any speed at all. We want it to just sit there and do nothing. Now, while it's sitting there, we will go and find the right people to make this happen, to close the deals, and to make our little fraction of a penny. That's how they work, okay? Now, speed is 100% the most important thing in your retirement investing. Hands down. Every other advisor on the planet is going to say, pick a good mutual fund, or Dave Ramsey, pick these 4 mutual funds and you'll do great. They're not bad. I won't say anything bad about them, but that's what they know. That's where they're at. And so while you may want to do that, really the question is, do those 4 mutual funds move at a speed that works for you? And so our only goal is to make sure that I can quantify to you over the long run. Give me enough time and I can tell you that if this is the S&P 500 and you told me that you want to move at a speed half of that because you're close to retirement or something, I can do that. I can quantify that in an actual way and prove to you that it'll work. Our performance is right on our website. The actual portfolios that move at different levels, different speeds of the market, all on the website. There's nothing to hide. I'm not a great stock picker. I'm not saying that I'm going to go guess the next hot stock, right? I mean, I have a history of doing that. I like doing that. It's a lot of fun. But when it comes to your retirement, I can't take a guess for 30 years from now. If I'm going to buy a stock because I think tomorrow it'll go up, no problem, right? I can be wrong on that choice. I can be right, make some money, or I can be wrong, find out quickly and move on. With all of our customers, I can't pick stocks and then say, well, trust me, right? And now you're 65 and that trust that you put into me didn't work. Oh, my guesses were wrong. I'm sorry. I thought, you know, GE would come out of it. I thought they would make it. You know, I'm sorry, I was wrong. You can't do that. You have to be able to tell a customer, look, you want to take this much risk? I promise you we'll get there, right? Put in the right amount of money. And that's another point too. If you have a long time until retirement, right, and you can't afford to put a lot of money away, then we need to move as aggressively as possible, okay? If you have very little money to put away. If you're like Dustin, I can put away a ton of money every single week, then we don't have to swing as hard. You don't need that much risk. We can move slower, okay? So that's the name of the game. I hope I didn't confuse you. I hope everybody didn't just leave. It's one of those things that I could talk about for probably days, honestly. I could talk about it for days because it's the geeky side of things that I really, really enjoy sort of explaining how they work. And nobody else is going to tell you how that works. It is an amazing thing. Another way you might look this up is high frequency trading. A lot of people talk about that being bad. That's everything I just described to you is high frequency trading. How is it bad when you win, you get a better price, the other side of the party gets a better price than what they thought, and the company that's facilitating all of this gets a chance to cover their costs so they don't have to charge you. So 100% better than an index fund. All right, question, if you buy an ETF and you pay the brokerage fee, if you have TD Ameritrade, do you still have to pay the other fees the ETF might have? Oh yeah, absolutely. Yep. So the commission, like for TD Ameritrade, is, I'm not sure exactly. I think it's $6.95. So that $6.95 goes directly to TD, right? The product that you buy, this ETF that you end up buying, has a cost as well, and it might be something silly. Well, you get the point. It might be a 0.05% a year. Now, with an ETF, Lucas, you don't actually pay that, by the way. So mutual funds, when you buy, first of all, when you buy a mutual fund, that bid and offer I was just talking about is backwards. So let's say it's $28.60. The other price over here that you're going to see is $28.40. They do it backwards. That's where they make their money. If you want to buy an exchange-traded fund, you must, a mutual fund, you must pay $28.60 at that time. If you were even allowed to immediately change your mind and get out, it cost you 20 cents, or it cost you something, whatever that number is. So mutual funds make their money off that spread, and they advertise the spread right up front. Then they have the fee as well, that percentage that you have to pay out of your account. With exchange-traded funds, whatever the cost is, they take it out of the price of the exchange-traded fund. So if this exchange-traded fund was trading for, say, $100, and you bought it, you would never see a debit from your account for that fee. Zero. When over the years, as this exchange traded fund is moving around, hopefully higher for you, as the price is moving, they slowly take that fee out of the price of the stock, just little by little. It's like many, 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 many fractions of a penny, and that's how they get paid. So you actually never pay that fee. And in most cases, if you choose the right exchange traded funds, the dividends that you collect from these exchange traded funds more than offset the cost. Okay, so you never have to, let's put it this way, you'll never see some charge that says like ETF expense ratio or something. If you choose an ETF that costs a lot, then the dividends may not offset it. So that's why a lot of people say exchange traded funds are free, right? They're not technically, but to you, you never actually pay. So now we've got exchange traded funds that you don't actually pay for. You've got trading, buy and sell as much as you want. Lucas, you're a great example. You know the investments in your portfolio. That's one of our customers there. You know what you have in there, those sort of custom things that you want. And when you tell us, I want to add more or change the percentage, now you know why it doesn't cost you a penny, because other people are helping to sort of pay for that for you. So look, in the retail world, all of you are picking stocks. I will continue to push this, that you should learn or get someone to do this for you. Move at the speed you need to move at relative to your goal. Has nothing to do with picking a winning stock. I do not care. When I update you guys, all of our customers on our portfolios, you notice how I never say, oh man, we bought this stock or added this to our portfolio and it had a great win. I never brag about that. It doesn't matter. I don't care which one happens. My concern is that things move as fast as they're supposed to. I made a promise to you. I posted it on our website, how I told you this I even tell you how we build the portfolio. But I make that promise that we will move at this speed. That's the promise I need to keep. I don't care if something goes up, something's going to go down. It's just always going to happen. That's the stress that I don't want to deal with. So, hey, that's it. If I helped you in some way today, hit the subscribe button for us. If you want someone to work with you, your retirement investments, long-term investing, I hope you'll check us out at Jazz Wealth. If I scared you away, honestly, there's going to be 2 more days of me scaring you probably. We're going to continue the geeky talk until the end of the week, and then we'll be back to normal, right? And then we'll wait a week or so and we'll do it again. So hopefully I didn't scare you away. If you have any questions, you want to talk about this, chat with Jazz on our website. You can schedule a call with me directly anytime you are ready. We'll be back at 4 o'clock, of course, to update you on the market. Lots of interesting things happening today, so be sure to check back at 4 o'clock. If you do hit the subscribe button, hit the bell. That should let you know when we go live. And that's all I got. Time for lunch. See you guys later.